Welcome to this video on an introduction to management accounting. When we speak about accounting, most people automatically think about sets of financial statements, the recording of transactions in journals and ledgers, and other things generally related to financial accounting. While financial accounting is really important for communicating a company's past performance to outside stakeholders, in this video we want to explore management accounting, which is at the heart of decision making within a business and the engine to ensure the company achieves its goals. So, in this video, we want to understand what management accounting is and how it fits into the broader field of accounting. To understand what management accounting is and how it fits into the broader field of accounting, we first need to understand what accounting is. We then need to understand the different users of accounting information and how their needs differ. Once these differences in needs have been highlighted, we will differentiate between financial accounting and management accounting before looking at a definition of management accounting. Finally, we will look at the three pillars of management accounting, being costing, decision-making, and planning and control. Accounting is considered a language of communicating economic information to various parties. In 1966, the American Accounting Association defined accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. There are three questions this definition answers. First, what is accounting? Second, why do we have accounting? And third, for whom is accounting? The what is answered by the first part of the definition. It is the process of identifying, measuring, and communicating economic information. The why question is then answered in the middle. Accounting allows us to make informed judgments and decisions. Finally, the for whom is answered at the end. It is for the users of that information. As we will see in our next slide, different users need to make different decisions, and the information needs are different based on the decisions they are trying to make. Let us consider the various users of accounting information. This slide lists some of the key stakeholders in an organization, but is by no means exhaustive. So who are some of these key stakeholders, and what do they need the accounting information for? First, we have government and regulators. They may require information for economic reasons and to make decisions around resource allocation. They may also require information to ensure compliance with regulations and laws. We also have providers of finance, such as our loan providers and our creditors. They would be interested in the solvency and liquidity of the business to see if the organization can repay its financial obligations. Shareholders and investors would want information of the financial performance of the investment as well as its current value. The organization's management would want information to assist them with decision making and control, so that they can better lead the organization towards its goals. Finally, employees may require accounting information in order to perform their day-to-day jobs. They may also be interested in accounting information to determine their job security and for wage negotiations. Based on this, we can see that there are two clear categories of users of accounting information. First, we have our external users, who are generally interested in verifiable and precise information that is uniform across entities so that comparisons can be drawn. This is why financial accounting, with its standards such as IFRS, is useful for external reporting purposes. It provides us with an accurate historical picture of the firm as a whole. This information, however, may not be useful to our internal users who need information now. They cannot wait for the end of the reporting period and for the auditors to come and do their jobs. Internal users need information that is timely and relevant to the specific decisions they are making. An internal user may only need information about one division or one product line rather than the entire company. Also, an internal user may require more detailed information than that provided by the accounting standards. Now that we have seen the different users and their different needs for accounting information, let us compare financial and management accounting. Our first difference is the requirement for financial and management accounting. Financial accounting is a statutory requirement generally written into a country's law or required by the regulator. Management accounting, on the other hand, is optional. Information is only provided if the benefit it offers management exceeds the cost of collecting it. Next, we can consider the framework of each. Financial accounting is governed by accounting standards, such as the International Financial Reporting Standards set by the International Accounting Standards Board. These standards ensure uniformity and consistency across different companies. Management accounting has no set standards. While there are best practices, the focus is on serving the needs of management and providing management with information that is useful for their decision-making, planning, and control. Next, we see that financial accounting provides a summarized snapshot of the entire business. Management accounting, however, focuses on parts of the business which are of interest to management. So maybe it could focus on just one store, or one geographical region, or one product line. Management accounting can also go into significantly more detail than financial accounting, if doing so helps management to make better decisions and control the entity. We can then look at the time dimensions of financial accounting and management accounting. Financial accounting focuses on the past. It reports on facts that have already happened. Management accounting, however, is concerned with decision-making, planning, and control. These tasks require information about both the past and the future. Management is concerned with where the company is going in the future, and therefore needs to be able to estimate future revenues and costs in order to make decisions going forward. Finally, we can look at the frequency of reporting. A detailed set of financial accounts are produced annually. Summarized versions can also be prepared on a biannual or quarterly basis, depending on the requirements of the country and regulators. These financial statements are normally audited and take a long time to prepare. On the other hand, management needs information quickly, and they also require up-to-date information. For this reason, different types of management accounts have different frequencies of reporting. Some may be on a daily, weekly, or monthly basis, while others may be on an ad hoc basis. Now that we have seen who the users of management accounting are, their different needs to users of financial accounting information, and the differences between financial and management accounting, let us now define management accounting and unpack the definition. The Chartered Institute of Management Accountants defines management accounting as the application of the principles of accounting and financial management to create, protect, preserve, and increase value for the stakeholders of for-profit and not-for-profit enterprises in the public and private sectors. Management accounting is an integral part of management. Looking at this definition, we see that management accounting combines the principles of accounting and financial management. We see that the role of the management accountant is not just about reporting numbers, rather it is concerned about value, specifically the creation, protection, preservation, and increase of value for all stakeholders. When we talk about stakeholders, we are not only looking at value for shareholders, but rather all parties who have an interest in the organization. This means that management accounting plays an important role for ethical practices, the environment, and society at large. We also see that management accounting is not limited to specific types of organizations. Rather, it is useful to all organizations, whether they are for-profit or not-for-profit, whether they are public or private. Finally, we see that managers cannot manage an enterprise without the information provided by management accounting. It is at the heart of managing a business. Let us wrap up this video by looking at the 3 pillars of management accounting. Our first pillar is costing. This pillar is concerned with the accurate provision of information. We require costs to be accurately allocated to products so that we can measure our performance for both internal and external purposes. Accurate costing also helps us to make good decisions, as well as to control our business going forward. Remember that if we get our costing wrong, we will use incorrect information to make our decisions, and we will make poor judgments. Our second pillar is decision making. Management accounting needs to provide information that helps management to make good decisions, keep the business alive, and create value for all our stakeholders. Finally, our third pillar is planning and control. Here we need to provide information that helps us to take the company in the right direction. We also need to be able to identify areas where we are not performing according to plan and can improve. Join us on our next video in our introductory series as we look at various cost terms and concepts.